question around buy right and sit tight, right? It sounds so simple, but it's very, very difficult, isn't it? Buy right, let's first talk about that. How does one buy right? Certainly on the mid-cap side, there's been a fair amount of negative bias. So how do you buy right in a market like this?
So obviously, this kind of market throws up a few more opportunities than what it would have been in the past. And on a lighter note, I can tell you that last year, when the returns were looking very, very good, everybody was very worried about the valuations. And right now, as we speak, like you introduced in the last 6 months, the returns aren't looking very good. But that also means that valuations are getting close to, better. So one thing to keep in mind in these kind of markets is that when the returns look great, valuations won't look that great. And when valuations start looking better, then obviously no point complaining about the past return. But coming to what you asked, I think that these kind of markets throw up a few more opportunities, because if you see last 1 year, clearly there would be many companies whose earnings have grown by 15-20%. And in the last 6 months itself, their share prices are down by about 15-20%. So that would throw up a few more opportunities. There are a few things which will start getting attractive. When we come to buy right, I think, this is a buy right, sit tight is a kind of adage which was coined by Jesse Livermore, written way back in 1922, 1923. So it's a very well-known kind of statement as far as markets are concerned. But it sounds simple, very difficult to practice. When you say buy right, what you are trying to do actually is to buy high quality companies. There are certain traits of quality oriented companies which is related to the kind of sector that they are operating in. Are those sectors secular? Do they have managements which are perceived to be great managements? Do they have execution capability? And at the same time, are all the financial parameters like return on equities, the leverage ratios, the rate at which earnings are growing, sustainability of those earnings. Because when we say buy and hold, when we say buy right and then we say sit tight, then obviously we want to be able to buy companies which we can hold on to for a period of time. So the growth should not be flash in the pan. There has to be growth which has shown some track record and where we have a visibility that it can sustain for some time to come. Only then we can hold on. So sounds simple, but there's a lot of arithmetic behind it.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.